This guy 4.5 million 50, you think what every Singaporean can reach? And I would say that a lot of people try to optimize the 5-year CAGR, but I actually try to optimize the 10-year CAGR is the way that I view it.
Because anyway, it's like what, 10, 20K, I can afford to lose that amount of money, right?
This guy has only 5 positions, he's talking cock out of his mouth, and he says it's very gassy, but I literally am opening up my portfolio now, and I cannot deny I am losing the BTC at the moment on a CAGR basis. I'm doing 23%.
Anyway, I need to first thank ContraTurtle. The last time we made an episode was pre-GE, I believe. After 1 month later, we'll drop the bank and then suddenly we have ContraTurtle on. I just wanted to clarify, is this like your first podcast that you went on?
Yeah.
It's your first, right? Okay, yeah, so we're extremely honored. But anyway, let's start the podcast proper. So welcome back to a long-awaited Backholder Pod after quite some time. Hope you guys didn't miss us. A really up and rising new creator in the Singapore scene. So for those of you who don't know, we'll leave the link in the description below. But I doubt so because he has more subscribers than us. But anyhow, I think for ContraTurtle, he really piloted pretty interesting concepts. I think one personal appreciation at least is he was willing to go out to slay some of the sacred cows, especially talking about the entire condo versus investing portfolio discussion. But before that, I think really wanted to know you as a person before we go into the nitty-gritties and the details, right? Just wanted to understand a little bit more on like maybe a bit of your background and pre-creating this whole YouTube channel thing. What has your general investment style or life has been like?
Actually, I'm like 38 this year lah. So in my 20s, I did a lot of trading. Try to buy low and then you try to sell high, or some options and stuff like that. After a few years in my 20s was that sometimes the trading profits feels like it's about luck. Or sometimes, yeah, maybe I am quite good with the support and resistance and the MACD indicators and what have you. But what I found is that if I had just simply held those positions, especially if they are good companies, strong ones with high quality, long-term prospects and stuff, and good management, the amount of money I would have made would have been much more than all the ins and outs I tried to make along the way. Because you cannot time it perfectly. Very impatient style to a more patient style. There was certain lessons I learned in my 20s where I realized that the faster I try to rush anything, it doesn't matter whether it's trading it can be anything try to make money or try to rush to do certain things to accomplish certain goals, the slower I'll get. So there's a very common phrase that I learned from Jeff Bezos, which he actually learned from the Marines, which he says, slow is smooth and smooth is fast. Yeah, so I've tried to live by that philosophy ever since. I try to add a bit of twist to it. I like to say slow is smooth and smooth is suddenly fast. And the reason for that is because if you hold a compounding stock, I think like you guys will know, especially if you hold a stock long term, like a strong company, like Bunty, you hold Nvidia, right? Long term. At first it was slow, right? PE is slow, everything's slow. Then all of a sudden, when a catalyst hits in 2022, right? The GPT wave came in and the GPU sales for Nvidia went up. It becomes suddenly fast. So patience pays off after you hold on to a thesis long term.
But your timing in quite a number of your picks also quite interesting, right? Maybe we can share a bit on ContraTurtle's portfolio. I think your portfolio is very concentrated, but the timing that you got into some of these positions, the one that I remember the most is Exxon, because when we meet up, you told me about this company, and then after that, it just keep rocketing up, right?
So I think this doubling within a span of 1 quarter is pure luck. I think anybody who says that they can double every quarter after they buy in, right? I think it's impossible unless you're Jim Simmons. Yeah, you have an army of PhD mathematicians behind you and you do real trading. TLDR is, to your question, is definitely is luck. But if you ask me, did I expect such returns over say 10 years? I would say, yeah, I did, because that's part of my thesis. It's just lucky that those returns came way earlier than I thought. The reason why it lifted my portfolio a lot in terms of CAGR returns is because that single move meant I had to sell another company. And the company that I had to sell was Netflix. And can you imagine Netflix has tripled since the beginning I bought it way earlier, right? So for me to even make that decision, right, it must mean that in my head, I had to balance the opportunity cost to say that I believe that in the long term, Exxon should grow faster and more steadily with a stronger moat than Netflix. I had to make that kind of judgment call.
I think we are jumping a bit too fast suddenly talking about this company Exxon, given that this is not even a hot company that everyone talk about. But let's take a step back just to let the audience know, right? Because can you just run through with us, like, what is your overall philosophy when creating this portfolio? Because it's very concentrated, and it seems that you have a very clear strategy that you are executing, right? How do you do these kind of selections and end up only 4 or 5 names?
My biggest position is Meta at nearly 30%. Exxon is about 23%. Netflix is 20%. Mercado Libre is 14%, and Amazon is 12%. So there are many things that I need to tackle here. We need to tackle the elephant in the room first, which is why is it so concentrated? And it's also the top most asked questions by a lot of my own viewers. And the reason for that is because behind every stock that you see in my portfolio, there is probably 10 more stocks behind that I've eliminated. So people only see what I bought, but they do not see what I have rejected. So the truth is that since the beginning that I've started investing, I would say I have rejected at least 70 to 80 companies. And that is not just surface rejections, which means I really go into each company. I study the business model and the product first, and I study the management by looking at the interviews, earnings calls, and reading their transcripts, and also checking through their YouTube, any interviews that are available about them before I eliminate them. So my process is actually by inversion, that's inspired by Charlie Munger. What I do is that I find excuses not to invest in the company. And until I find no reasons not to invest in it, then I'll invest in it. The first criteria I straight away shave off the company is my circle of competence, which means I have to absolutely understand how the business model works, what is the product they're selling, the market and the industry they're in. And the reason I will know and it is within my circle of competence is because I either work in the industry, because I work in technology, I've worked in e-commerce, advertising technology, and inventory management, and just generally software based, which is why you see I do not hold NVIDIA or ASML or TSMC. And then also management, they have to demonstrate integrity. They have to demonstrate skin and soul in the game. Skin in the game means that I will actually go and dive and check the Forbes, their net worth if they are a popular person, or I need to do some simple math to check what is their personal net worth. And then I will check how much stock holdings they own in the company and check how does that measure relative to their personal net worth. But I go by inversion to answer your question. And there are actually companies on my watch list, about 8 to 10 at the moment, but I've been waiting very patiently for them.
Wait, is there a reason why you keep to 5, specifically 5? Why not 4? Why not 3?
The 5 is not a set number that I wanted to get, which is like, oh, I want 5. It's more like at the time when I bought it, I could only find these 5 opportunities that meet my criteria as I continue researching the stocks. And I think one thing was I was limited by the speed I was researching those stocks, because at the time when I bought it, I think it was about 2021 or something like that. I can't remember, but every company I would study for quite a while, and then I buy, study for quite a while, and I buy. And by the time I reach certain companies I really want to buy, like Hermes is one of those on my watch list. I will argue Microsoft is also, and Booking.com also. By the time I reached to those names and I decided, oh, they pass my inversion criteria, but the valuation now GG. So I came too late.
You say the number is flexible, but earlier you said that you sold Netflix, is it, for Exxon? So I was thinking, like, is it because you have to keep to 5, that's why you need to sell 1 so that you can accommodate 1 more?
Oh, the reasons I sold Netflix, right? Okay, this one's gonna be a controversial take. I believe that Exxon's long-term moat and growth prospects are actually stronger than Netflix. And I think it's very we will have a tendency to look at the current price action of Netflix and Exxon, and we'll be like, this guy Netflix tripled, Exxon only doubled, right? I mean, in recent times, in the last 1 to 2 years, right? What makes you think that Exxon will go up? Yeah, this when you have to make a judgment call and not look at the price, because there's anchoring bias by price. You have to look at the revenues and the kind of catalysts that are on the horizon for the company compared to Netflix, right? So if I compare the explosiveness of the catalyst, Netflix is about tapping into the advertising market, right? So they're going into exclusive live streaming with sports and WWE, wrestling, and then they're going to start putting in premium ads. They're going to build their own ad center. That's not bad. But with Exxon, it's even more explosive because they are transitioning from a hardware taser solution to a software solution, which has higher higher margins on delivery on average software. Which is why in 2022, the transition of Exxon in terms of the revenue mix has crossed the 50% mark towards evidence.com, which is software. And so I think there's what we call a Lollapalooza effect, if I quote Munger, which means that you have this multiple effects that compound together. On one hand, you have exploding revenue base from increasing software. On another hand, this increasing software revenue base is a high margin base. So you have two effects that are compounding. So I felt that this effect outweighs the explosiveness of Netflix's catalyst. And I made that judgment. And so when my opinion is that when you do reallocation of resources, let's say when you sell Netflix or something, right? I only really sell a company for two reasons. One is that I think that another company can perform better long term, which is why I made the judgment for Netflix to Exxon. The second reason is I need money. I don't sell the stock for any other reason like trimming and stuff like that, which is very common, right? People will say like, I get the most questions that Netflix has tripled for you, like why you don't sell now and then buy back later, right? I think what people actually you see a lot of people trimming. And I think the reason people trim is because they are afraid that they are leaving profits on the table. And I would say that a lot of people try to optimize the 5-year CAGR, but I actually try to optimize the 10-year CAGR is the way that I view it. So if I want to be on top of all my positions at any one time and know exactly what management and the product and the industry is doing, I cannot have more than too many names. Right. Just so like I think that will be diversification, as particularly says.
One way to argue against that is that, for example, I look at my portfolio, right? I see my portfolio as a lot more diversified as compared to yours. But how I have comfort is not saying that, oh, because it's diversified, so my portfolio is very safe. It's not like that. It's more like once I have, let's say, like quite a number of portfolio, each of them actually take out like quite a small percentage, right? Let's say I position with, let's say, 3%, 5%. 3%, 5%, you look at the exposure, probably it's like, let's say like 10 or 20K into one stocks, right? Actually, with that amount invested in that company, actually I can afford not to follow them as closely. Like it's not like at one news come out, I need to jump into it and read into it and see whether I need to do something about it, right? I would just slip over that and then wait 1 quarter, result come out, read a bit. And even if I skip 1 quarter of earnings call, I also fine. Because anyway, it's like what, 10, 20K, I can afford to lose that amount of money, right? So that,
yeah, I think that there is no right or wrong, to be very honest. And I don't say that just to patronize. I say that because I think it's actually true. So the management style that you mentioned, which is you have a couple of positions and you limit them by, I don't know, like 2 or 3% per position. Mathematically, yes, it does make sense. And I fully agree with that. And in fact, that style of investing also has an upside, which is I see it as a VC kind of philosophy, which is if you spread your seeds across 30 or 40 names, and of course, there's a trade-off, like you said, you don't have to monitor. So the trade-off is you don't know the companies as well. But because you're spreading your seeds wider, the probability of any one of your seeds, assuming they are not bad, suddenly exploding like an NVIDIA is very high because you have a wide surface area of exposure. So I think there's no right or wrong. It's really about philosophy. For me, I think the first and foremost is my character. I got a bit of OCD purist thing where I need to know everything that I do and really understand to the T. Then I'll put money in. Because I'm actually very conservative. And I know it sounds counterintuitive, like this guy has only 5 positions, he's talking cock out of his mouth, and he says that it's very gassy. But the truth is that I don't dare to invest if I don't know the company. That's why I'm so slow in allocating money slowly, one bit at a time.
So you have your watch list. I have a few stocks.
Yep.
So one of it is Google. Because right now I suppose Google, a lot of people say that it's undervalued. So what's stopping you from buying into that stock right now?
Okay, so this will be the first one that I'll air my public thoughts on this, because this one is it's controversial, but not as controversial as Palantir and Tesla lah. So I'll talk about it. With Google, it is on my watch list, but I'm on a wait and see for two things. The first thing is that, surprisingly, I don't like the CEO. I don't like Sundar Pichai. Yeah, so I have a certain criteria for management that I choose. And Google is on my watch list because I need the CEO to be leave first to get rid of him. And I need someone like Satya Nadella to take over him. And the reason for that is because if you track Google's earnings calls and you listen to Sundar Pichai talk, and you just look at the way he responds to analyst questions, you will know that he's a very cagey CEO. And the reason is actually very simple. We don't need to complicate it. If you look at the stock filings of Google shareholders, the real two people that wear the pants in Google is not Sundar Pichai. It's Sergey and Larry Page. It's just that simple, right? Which is why recently there was an Google I/O conference, and post the conference there was an interview, and you can see that Sergey appeared as a guest with Demis, who is the CEO of DeepMind, in charge of the AI research lab work, right? And there was a comment where the interviewer asked Demis, who is supposedly here at DeepMind, when do you think AGI will be reached? And he said probably after 2030. And then Sergey said, no, you got to do it before 2030, which is within the next 5 years. You got to reach artificial general intelligence. And the way he said it is very different from the way Sundar Pichai promises stuff on his calls. Only Sergey can make a commitment like that, but Sundar Pichai cannot. He's constantly waiting for orders. So there's a lot of bureaucracy right now in Google. And yet we will never have a day where Larry Page and Sergey will ever be CEO. Why? Because they are simple research scientists and they know it themselves. They're engineers. Which is why all along in Google's history, they have barely been CEOs for extended periods of time. Before Sundar Pichai, it was Eric Schmidt. And I'll argue that I would rather take Eric Schmidt or someone like Satya Nadella over Sundar Pichai any time of day. If you just look at it, you understand. You got to study long enough. He's scared out of his boss to make any decisive move. So it's only when the pants is on fire recently that you guys start to see Sundar Pichai going on all the. Do you guys notice he's on Lex Fridman? He's on all the interview calls because his boss are on fire now. If you look at the GPT numbers in terms of visitations, Gemini is peeling way in comparison. And if you look at the CEO of Perplexity, he came out in an interview recently I think Perplexity, right, which is the other GPT thing that, to be honest, is just a wrapper company lah. It's just I don't even know what models he's using. I mean, he's probably using GPT also lah. But he came out and made a statement which I thought was very pertinent. He said that Google has been talking about revamping their search to become a chatbot and embrace LLM fully. But they've been talking about it for 3 years. And all they've done is creating AI overviews, AI mode. But if you go to google.com today, nothing has changed. It is still Google search first, followed by chat as a secondary. So, sorry, I went one big wrong. I have to come back to your question. I did not invest in Google right now, and it's only on my watch list because of 2 trigger points I'm waiting for. Number one, I need the CEO to be removed. Number two, I actually think that Google is facing Innovators dilemma at the moment.
Yeah, just I wanted to bring up this Innovators dilemma. I think the situation is this, right? What they are facing is definitely Innovators dilemma, meaning that whatever they do, right, they have to change their core product, which is Google search, and that is the one that delivers them all the revenue and all the profits. I know someone mentioned that it's actually delivering, let's say, like 120% of the entire company's earnings, because there are many lines that is not profitable, right? So they have to subsidize those lines. That is just the situation of the business, of their offering, of the competitions, right? The other part is what you mentioned, is the leadership, is the management style, those kind of things. And you are saying that this now is very clear, the problems coming from from both sides, both the leadership and also the situation that they are in. I'm just thinking that, let's say if we compare the situation, right, go back to, because I just read about Microsoft era when they lost to so many other companies. For example, they lost to Google, Android, lost to the mobile, everything they lost in about year 2005 until they hired Satya Nadella, right? Then everything just take off from there, right? So I'm just thinking that for Google, do you see that there's still chance that there might be big changes coming just because they are forced to, and just because their core remains very strong, right? They will still be a dominant players, just like Microsoft. It's not like they lost in some new area and then the entire company is dying. It's not like that, right? It's not that easy. And Google owning all these YouTube, Android, these are still very valuable assets, right? That they can play with in the future. What do you see about balance the opportunities versus the situation, the mess that they're in now?
The biggest difference I would say between what happened to Microsoft during the mobile phone era and Google at the moment with the GPT era is the mix of revenue. I think that's the biggest difference. At the moment, Google's revenues in search was it 90%? I can't remember, somewhere close to 90%, right? Whereas in Microsoft's case in the phone era, it was more about creating a new stream of revenue with going into mobile and creating a new iOS or Android ecosystem, which they failed. If they got that, great news for Microsoft. They will have unlocked a new stream of revenue on top of their already strong Office package, which obviously Nadella came in and then he strengthened it even more by introducing Azure as cloud computing, which really lifted Microsoft stocks. But I think the problem with Google right now is, I fully agree with you that there is Android, there is Waymo, which is a huge total addressable market. And then we also have Google Cloud Computing, right, which has about, I think, like 30-something% annual growth rates. It's fantastic businesses. And the sheer talent density that is inside Google in terms of the research lab and AI. I mean, if you think about it, it's quite irony. Google themselves wrote the Transformer paper, which is called Attention is All You Need, which is the one that started the entire AI hype that we see today. Actually, it started from Google, not OpenAI. Google was the one that wrote that paper in 2007 or 2017, can't remember. Right. But the point I'm making is that it's the revenue mix that is the risk and the difference in Google at the moment. Because search is at 90% of the revenue mix, right? The innovators' dilemmas factor is even bigger for Google compared to Microsoft back in the days. Because if they were to make this huge at the moment, right, it means they have to make a 90% revenue mix decision. Which at the moment, what happened was that, when Google made their AI mode even more prevalent in the current search, google.com, they actually had pushback from their publishers already. There are some publishers that have written into Google CEO and complained to him saying that, how is this relationship going to work with our blue links now slowly starting to fade away and you have overviews at the top? We are not getting recognition in terms of revenue because a lot of the search queries are now being swallowed up by AI overviews right at the top of the page that don't give any revenue to publishers because people are clicking less and less in the blue links. Even just like this with overviews, right? Not even revamping the 90% of search, right? The publishers are already pushing back. And so I really believe that it's because of the revenue mix. If let's say you flip it around, if search is only 20% of Google, right? I tell you right now today, I will close this podcast and I'll go and invest in Google right now. Because the catalyst is so strong, there are so many streams of revenue, right? Between the Android ecosystem and Waymo and GCP, Google Cloud Platform, right? So it's really the percentage that bothers me the most.
Actually, on this whole Microsoft thing, right, I just finished a Quiet podcast with Steve Ballmer. He talked with them for 3 hours. And quite interestingly, he mapped out his whole journey with Microsoft. And of course, a lot of people flagged him for being a very lousy CEO because he basically made Microsoft a lost decade. But he did kind of hinted. I just wanted to draw a few points from what I can recall. You can fact check me after the podcast. A few things to take note of. Firstly, I think when he took over from Bill Gates, it was one of the highest valuation because it was during the .com. So there was this very big multiple contraction. But I think on basically all the fundamentals of earnings per share, and if you flag him out based on the same multiple, he actually brought, I think, 2 to 3x in terms of enterprise value for the company itself. That's the first point. Second point also is because when he was working with Bill Gates, even though he was like independent, quote unquote, like Bill Gates kind of hands off, but he wasn't hands off. So he was still in like board meetings, he was still there. He can have very big arguments with both of them, even though they kind of like started a lot of all these together. And he also said that his hands were kind of tight. So that's why he said that when he took over, or when Satya Nadella took over, he gave him free rein. And that's why Satya managed to come up. So I'm not too sure whether it's the same case with Google now, today, when you still have the initial international founders there still trying to mess with things and stuff. But I think we'll see. So that's the second point. And I think the third point, when you talk a lot about like Steve Ballmer being a bad CEO, right? He did, number one, he stayed very long, quite a long tenure. Number two, in order for Satya to kind of unlock the catalyst, right, he needs good foundation. So no matter how bad you can scold Ballmer, right, he still put in a lot of the efforts and research into the whole infrastructure, cloud computing, which kind of took off. And he called it like the second trick. So I think one of the conversations he floated was that a lot of the companies that you see in the world today, they're all one trick pony, meaning they got big because of like one kind of winning. I think one other example he brought up was probably Amazon. So Amazon was a 2 trick. And now he's saying that Microsoft is on the way to the 3rd trick. But at least I think one drawing concern when I hear the both of you talk about Google just now was that, and whether YouTube and Google Cloud alone can justify that 2 trillion valuation. Meaning to say, let's say I write off search. Of course, not saying writing off totally to zero, but let's say I cut it into half, cut it 75%. Does it still make sense? I think that comes from a valuation point of view. So that's just my perspective on this whole Google investment thesis today. Yeah, just want to know your thoughts.
Yeah, okay. So this is a great question, because this will fall into my character of kiasiness, and you will see how kiasi I am. Chiking's point is actually something we call the sum of parts valuation, which means, is there a way we can value Google such that even if search goes to zero one day, but they are left with such valuable assets such as YouTube, Waymo, Google Cloud Platform, Android, etc., right, and their AI research lab, that it's still worth paying a price to own Google in spite of the fact that search can go to zero one day. The philosophy I have when I look at a company like this, right, where they have an existential risk, but then I had to go into this sum of parts valuation mode, which is actually the general term to describe this way of looking at companies, which means we are literally breaking down the parts of the company to see the sum of parts, whether they make sense to buy at a certain valuation. When I go into this situation, right, I tend to shun away. And the reason for that is because I don't even want to go to a position where a company has a risk of getting fragmented or broken apart to that extent. I prefer to have a company that I know will be stable, where I do not have to resort to sum of parts valuation, and will remain as a whole core as it is. And on top of this functioning core that will not be affected by any secular trends like AI, like LLM eating such as lunch, etc. So I had that base first, and then I built catalysts on top of that. So as an example, the reason why I'm invested in maybe like a company like Meta. Okay, Meta is a great example, right? It's my biggest position. Why am I invested in Meta? And this is related to this whole question of sum of parts and why I don't do that and why I prefer a stable base. Meta has a stable base at the moment. Their advertising black box thingy, which they are earning money from all of us when we are scrolling Instagram, Facebook, and soon WhatsApp, by the way. They just announced yesterday WhatsApp ads can come in. That's a stable base, and it's not going to go away anytime soon. Not even TikTok can make a dent in the market, right? Now, they have that stable advertising revenue base. On top of that, there's going to be extra catalysts that are going to come in. For example, the Ray-Ban glasses, and now Oki glasses, which Zuck has just announced, right? 2 glasses. And on top of that, we have WhatsApp AI agents that are coming that will make even more money, right? So these are extra catalysts on top of a stable base that will not be fragmented. So for me, the philosophy I have is that I need the base not to be fragmented, and I don't want to judge that base by sum of parts. It just has to be stable.
Actually, on the same note, it's the same coin with different sides, right? If you think of it like, I'm so pessimistic that today the most profitable part of the business goes to zero and the company is still worth X amount of valuation that they're in. I'm going to follow up. I think just this morning, right? Personally, I'm also a Meta shareholder. And I saw this news recently. I think Sam Altman went onto the podcast and he said that Meta is offering 9-figure compensation packages as sign-on bonus for some of his top AI executives. Just wanted to know, like, have you been following very closely in terms of Meta's development in the AI space, and what do you see of this like snatching of talent pool and how competitive it is in terms of compensation?
You have great questions, Chiking. And I literally just discussed with my friend Serging about this morning and last night. I think the entire talent poaching from Zuckerberg started with Scale AI, Alexander Wang. He offered him some ridiculous package to lead the AI lab in Meta. And to be very frank, it is a very telltale sign that Zuckerberg knows that Meta, the Llama model, is falling behind all the other AI models. And it's also the reason why Llama Behemoth that was supposed to be released, which is the biggest model, has been delayed. Until today, I have not seen any release from Llama Behemoth. In fact, if you try using @Meta on your WhatsApp or your Facebook or your Instagram, to be honest, it sucks, man. It really sucks. Especially if you're a GPT owner. You can tell anecdotally that it's really bad. So I think what Zuck is doing, which is at all costs poaching talent across the board from OpenAI, from Scale, it looks like a really, really expensive talent poaching exercise. But in the long term of things, I would say 5-10 years and beyond, I think it is the correct move. And only a founder, only a CEO with founder street cred can pull off something like this. There's no way the board can approve something like this if you are not a majority board. Of course, that's a double-edged sword lah. If you are a screwed up CEO, even you founder cred, you anyhow allocate capital to do this kind of poaching, it can also turn back badly on you lah. But which is why I keep drawing back to comparison like Sundar Pichai. He cannot do a move like that. What Zuckerberg does, impossible. He needs the approval of Sergey and Larry and Eric Schmidt, and there's this other investor on the board, which has even more shares than Sundar Pichai, right? Which is why, for Meta's case, to answer your question, I think in the short term, it is risky. It's a lot of money, really a lot of money. And Sam Altman obviously is not happy lah. He said that in the interview, the interview you're alluding to, I actually watched the interview. He said that that is not our culture in OpenAI. So he says lah. So anyway, that's a very subjective thing lah. But in the short term, I think yes, that's risky, right? All this money is being spent. But in the long term, I think it's the correct move. And just letting everyone know, the internal discussion I had with my friend Serging is that if you guys have been using GPT a lot, right, you will realize that GPT is becoming increasingly an engagement sink, which means that, do you realize that every time you ask ChatGPT a question, right, ChatGPT doesn't just answer a question, it always asks you a question at the end. Do you guys realize that? Do you realize that that creates more inference? Because you don't end the session there. You carry on talking to ChatGPT because ChatGPT asks you another open-ended question to hook you in to ask you even more. Do you guys get that when you use ChatGPT?
Yeah, get that all the time.
Actually, that part on engagement, I think can switch off one, if I'm not wrong lah.
Oh, really?
I saw it in the settings. I think it's but it's auto, like if you don't press, it will not switch off. But I get your engagement point.
Okay, I'm sorry I went one big round because I promise I will come back to your initial point about the talent poaching. It's all related. And the reason I bring this up is because I believe Zuckerberg has noticed this. And if you think about it, Meta is in the market not just for advertising, but competing for attention and time. If users begin spending more and more time, right, in an engagement and time sink like GPT with open-ended questions, right, there's a very real risk that GPT can develop into the next media platform and challenge Zuck's reign with social media. Is very possible. All the GPT needs to do is create display ads alongside the time sync that they have now with ChatGPT, and all of a sudden it becomes like Instagram feed already. And then they start doing what Meta AI is doing now. Meta AI is actually controversially showing some questions people ask to Meta AI. Their GPT, they're showing like images that people are using to generate some random conversations, which is kind of sus lah. I mean, there's another question, there's another discussion lah. But GPT could easily pull something like that, and all of a sudden you have a mini Instagram there. And I believe Zuckerberg notices that it's becoming a time sink. It's competing for attention with Instagram and Facebook. And he has to respond in kind, which is why he's aggressively poaching. And this is why it's related to your initial question about spending all this money to poach. He sees the big picture long term, I believe.
I'm more interested in your portfolio. Prior to this, you said you were investing in triple Q, and you start like going into individual names lah because you wanted to retire by 50. It is in like 12 years time. So it's a 16.5% CAGR kind of thing lah. So I'm interested in when are you deploying the capital? Like, is it during downturns, like what Adam Khoo is doing, like buy during the dips or that kind of thing, or is it like what Bundy is doing every week, every month, where he's just buying C based on feel kind of thing?
Yeah, so I only buy when the company hits a certain valuation. So I don't really DCA with the stocks that I hold. I used the DCA when I did indexing with QQQ and S&P, and I actually think that makes sense. Even though statistically it's been shown that if you fire one big shot at the beginning of the year into the index, it actually outperforms the DCA. But obviously, because I am a regular working Singaporean, so I get money every month, new cash will come in. So if I were to index, it would just naturally be DCA because then I wouldn't have to think too much about that. And every month I come in and I just deploy. I don't have to hold and then deploy. It wouldn't make sense. But if I'm a businessman, that's very different. If I get cash flow upfront, then I'll probably deploy everything in the markets and the index at the start because statistically that performs. But to answer your question, Kelvin, you asked about how I actually allocate capital in. The general rule of thumb is that it has to hit a certain valuation level for each of my stocks. I preset buy levels for each company, and it really depends. If it's an early stage, fast-growing stage, not super high profit and free cash flow kind, maybe like Exxon, I would value it on the price to sales ratio or price to gross profit ratio. And what I do is that I look at the past 5 to 10 years historical average, or rather the median, not the average, the median to be specific. And then I compare the current PS, the price to gross profit, PGP value to the historical median, and see if it's above the median line or below the median line. That's one criteria. The second criteria that I have is that I look at the support and resistance. Surprisingly, I say I'm fundamental, but I actually look at technicals because I have a philosophy of never say never. I think if it works, I'll use it, whether it's a black or white cat. And actually, this one I learned from Adam Khoo because I follow some of his investment thesis and I subscribe to some of his services. And I think it makes a lot of sense. So Adam Khoo does this thing where as long as it's below the fair value that you judge, right? So for me, for Exxon, I look at PS and PGP. If it's below that, I actually look at the actual price levels historically, psychological levels. It could be the 200 moving average. It could be certain price levels that have been hitting. And then I plot like 1 to 2 or 3 support resistance lines below the fair value that I calculate. And then on top of that, I do this thing which probably only I'm doing this, like the thing that's specific to me is that I look at the all-time high. And I look at how much percent that is fallen from its all-time high. And the way I term this is the asymmetric math of gains and losses. And I don't make it sound too complicated. It's actually very, very simple because I don't want to complicate stuff and make it sound very fancy. It's actually like this. If let's say you buy a stock, right? Let's say the stock is $100 and it falls at 20% and it reaches $80, right? So that's a $20 loss, right? In order for the stock to go back to $100, right, it needs to gain 25%. If you do the math, because the denominator is now smaller, so the new number is $80 stock price, right? So if you gain it back to $100, you need to gain $20 out of the new denominator of $80. So that's actually 25% gain if you think about it, which means every company, right, that has fallen from an all-time high of 20%, right, the corresponding gain that you get when it reverts back to the original price, assuming it reverts, this is another topic altogether, it's going to be 25%. So if you think about it, there's asymmetry between gains and losses. The steeper the losses is, right, which is the greater the pessimism, right, the greater the potential for the future returns, because a 50% loss in the stock price for $100 to $50 is equivalent to 100% gain because he needs to gain $50 or $3 in the future. And so this is the third philosophy I layer on top of the fair value, which is PS/PGP, plus the 3 support resistance lines below fair value, and then another all-time high. And the reason why I figured this out is that there's actually a mathematical way to determine how long you should wait before you buy into a company such that the CAGR still makes sense given that you're waiting and have cash drag by the side. And actually, there is a mathematical answer to that. You can wait for 2.9 years. I've calculated it before. If I want to beat the S&P 500 index, I'm able, and simply put, to hold money in my bank account and wait for up to 3 years, such that as long as I can get any position that goes down 20% below the all-time high, such that it gets 25% on reverting back to the mean, assuming it's a strong quality company, which is another question altogether, okay, I will at the minimum match the 8% of the S&P benchmark. You guys understand this point? That is the opportunity cost that we have to beat, which is the market. We will assume 8%. So, and this is the reason why I believe, right, Warren Buffett, when he waits for, I don't know if you guys watched the recent Q&A conference for Berkshire Hathaway. Somebody asked him, how come he has so much money and cash now in Berkshire Hathaway? Why is he holding billions? Is it because he wants to pass a clean slate to Greg Abel so that he can take over and then you get? But Warren Buffett said, no, that's rubbish lah. Why would I give the honor of allocating capital to my next person? I rather take the honor and glory for myself to show that I can allocate the money better than him before I die. He actually said that. But you know what's really interesting is the statement he made after this. He said, well, the reason is very simple. There are simply no good companies by now, he said. I quote him, and he said that the probability of a company that will be at a value price for Berkshire Hathaway to buy is very unlikely that we'll be able to buy it tomorrow, next week, maybe even this year. But I think as time goes by, the probability of a fair value capital allocation will increase within the next few years. And I would say that under 5 years, there will definitely be opportunity for us to allocate capital such that we can get a good return. And I believe that there's actually a mathematics to Buffett's holding of cash. Because
what are your thoughts on Bitcoin? Because not obviously, historically, Bitcoin could have given you that kind of return. Like, why not just put another allocation into Bitcoin?
Say anything gonna work. But for me, I really personal preference. I really prefer to invest in productive assets, and companies that are making cash flows and they have a certain business model and they're selling a product. And I literally am opening up my portfolio now, and I cannot deny I am losing the BTC at the moment on a CAGR basis. I am doing 23%, and BTC is doing 26.51 on my portfolio. So what this means is that assuming if I had invested in BTC instead, I would have made a 26.5% CAGR per year. But right now, my investment is making 23%. So this is a 5-year horizon, right? So at the end of the day, my philosophy is very simple. There are many roads to Rome, right? If you find an asset that you're very comfortable with, and you believe in Michael Saylor, and you believe that Bitcoin is the strongest decentralized currency, and it will never go away, it'll become digital gold. It very much might be, I would just say that there are many ways to make money, many roads to Rome, and I respect everybody's way of making money. For me, I just lean towards the side of equities because I love studying businesses. It's our passion also for me. Yeah.
So I have a question for you. You were saying that your investment horizon is around 14 years, 4.5 million by 50. So after you hit that mark, right? Assuming that you do hit that mark, what are you gonna do? Are you gonna like quit and then full-time investing?
Oh wow, you guys ask really good questions there. I think that will be a mark where I reach financial freedom, where I can choose what I want to do and what I want to work on. It's not like I will. It's not necessarily I'll quit my job, to answer your question. It's more like it will be a safety net where it doesn't matter if I lose my job or if anything happens in my job, the cash flows that the portfolio will give me will still be enough for me to sustain my family. So I think that money will give me the flexibility to travel all the prefectures in Japan.
No, I think like a lot of people think that they have to reach this goal to do this, to do that. But by then they're probably a different person, different environment, different health. Everything also different already. So like a lot of Singaporeans say I have to reach 63, I can only retire. But like there's this girl called Jean, she like retired by 38, go to Bali, or she's already done with life. So yeah, I think 50, even the 4.5 million, I'm waiting for episode to share the explanation lah. So like most people don't really need that much amount of money. I'm sure Bunti can survive with just 500k lah, much less 4.5 million. So yeah, so I'm quite curious why is that such a big amount.
4.5 million, assuming that it's divested into local bank stocks, DBS, OCBC, UOB, and let's assume that you get a 4% dividend yield, it's approximately 15k per month, approximately lah. There are a lot of people that ask, have you factored in inflation and stuff like that? So the answer is yes. I made the amount artificially larger such that in spite of any inflation over the next 12 years, it doesn't matter. And I think it's an amount that covers me and my entire family to not have to have reservations with life and when we travel. And it really ties in a lot into my liabilities also. A lot of people say, oh, I want to earn for such a big money and this and that. But if you look at my current life, I don't drive a car, number one. I take public transport, bus and MRT, which is also why I like to be anonymous. Because you guys watching this, I could be the guy standing next to you in MRT, you know. I really could be. I dress very normally on nothing, right? And that's number one. And number two, I live in HDB BTO, right? And a lot of my aspects of my life of the car and the HDB, I think it's very unlikely that I'll change it even when I hit this amount. Which means, right, all this 15k per month deployment that I have, right, will purely be used to build memories for my family with no reservations. Yeah, so that's the way I see it lah. It's an amount that I will not have reservations when I go holiday.
Actually, on this note of being anonymous, right? Does anybody in real life, like your relatives or whoever, are they aware of the channel, or can they recognize you through your voice?
I don't think my family will notice that, but I mean, I'm not. The channel is so small lah. But I did have one friend who suddenly messaged me and said, "This has got to be you lah." Yeah, so maybe over time people will know. I'm okay with that. I think, you know, because my channel is really one of my goals that I figured my ikigai is that I want to help Singaporeans at scale with storytelling. That is one of the ikigai that I took very long to realize myself. And I will share this in the upcoming episode, but just a preview here is that so if people start to realize who I am, I think that's okay. But my main worry is that because I'm quite a shy guy and like I like privacy in person because and you know like I don't drive car, right? So I really will be taking bus at MRT. Then I cannot be plastering my face area. Then yeah, like I could be the guy next to you, you know, MRT guys. I really could be. In a way, I see it also as a very philosophical thing, right? I want to prove to Singaporeans that you guys keep yourself liability light, live a simple life, right? Even the guy standing next to you in HDB MRT, standing next to you in MRT or the bus, I could be any one of those people, and I want everyone to be able to relate to that because I don't want it to be a case that wow, this guy 4.5 million 50, you think what every Singaporean can reach? No, I want every Singaporean to believe that optimistically that you can do it, and I want to prove to you. If I fail along the way, I fail along the way because that's why I'm trained transparently everything. All right, we shall see in 12 to 15 years time. But part of the reason why I'm anonymous is also because philosophically, I want everyone to imagine that that person can be you. I could be you. All right. If you put a face to me, then you know it will make me look like I'm very distant. But because I could be anybody next to you on the MRT, I think that creates a sense of optimism and gives a bit of spark of hope for every Singaporean. So it's the way I look at it. But I say that but I think there are really cases should get a car. Like even for me, you got 2 kids, I think I'll get a car also. Simple car.
Yeah, I have 2 kids. Bunti have 2 kids. We don't have a car.
Well, then how do you manage like when you go around Singapore?
They don't know what to compare to, right?
Now I got baby, I've just been using Grab. Go
Don't
hospital.
have to like I mean I work from home. My kid studies at the nearby preschool. I've done the calculation. It's only worth it if you travel 2 times, at least 2 times. So it must be at least 3 times a day to make a car worth it. Otherwise, Grab is totally fine.
Mm.
Cheaper.
You see, the mentality that you have, right, is such a great mentality because you're viewing car as a utility rather than a status badge, which is like not worth it, lah, I think.
How is it?
Yeah, because that's exactly the mentality I'm trying to advocate, which is that if you really need a car and you really need it because you cannot cope or you really need it for family reasons, I really think you should. But I think whether or not you should pay a premium for a very expensive car, that is a totally different subject, lah. Yeah, and I say this because I've seen people who chase after that, and I really have seen people that got destroyed. I'm not even kidding. Like their life just get destroyed. Their credit card loans, everything, they cannot cope, and then they're divorce the family, and then the whole family just rip apart. Really, yeah. So I see this not as wow, this guy's studying trends on read newspaper, and then Straits Times report that the loan delinquency rate going up. No, it's not that. It's because I've seen actual people that I know that experience that. That's why I think, yeah, I just do what I can to stop this vicious cycle of chasing after stuff, lah.
Very interesting conversation, right? Like one of my friend brought it up to me. Actually, there is this self-selection bias, especially for people that make finance content or consume finance content. You are generally in a genre or buckets of like, I don't know how true is it lah. Don't quote me on this, but there's some study, the MBTI thing. You are either an architect or a logistician, like INTJ, ISTJ, or something along the lines of like ENTJ and ESTP, because you are someone with a plan, you try to execute it, you crave a lot of independence and stuff. So there is this like group of, like logicians or like architects that come together and then they form their own community on YouTube and then like circle jerk and stroke each other's egos saying, whoa, it's very good to not have condo and then take public transport. And then you have the rest of the other types of personality types. So that's just something that I came across quite recent. Not too sure what's the veracity or how true is it, but it does seem to me there is a certain thread that goes across a lot of all these, like a lot of us that we find a lot of commonalities of thinking from utility, not buying, not status signaling and stuff. But it's quite true that that's not the case for a lot of people around us. I think that's just some parting thoughts as well.
I think that's exactly why YouTube content creators like us have a duty, right? Because we are at the age of that domain. We are expanding that domain as much as we can to bring people to the fold so that it becomes a circle jerk, right? But a good circle jerk, right?
Very comprehensive discussion. Yeah, thanks for coming. Hope you guys enjoyed the discussion. Anything, please feel free to leave in the comments below. And we'll see you guys in the next episode. Goodbye.
Bye.
Bye.